In part 2 of our accounting cycle, we're going to take our adjusted trial balance, prepare financial statements, then look at why and how to prepare closing entries. We'll prepare post-closing trial balance, which will again set the stage for the next accounting cycle. We'll begin preparing with our income statement. Our revenues, we can tell from our trial balance for the year, were $39,300. We had $17,000 in operating expenses, $11,000 in depreciation expense, salaries expense of $13,600, and rent expense of $2,750, giving us total expenses of $44,350. Since this is more than our revenues of $39,300, we have an operating loss of $5,050 for the first year of our business. Since this is our first year in business, our beginning retained earnings, of course, is zero. We add to that net income, which in this case was a $5,050 operating loss. We had nothing in the way of dividends, so our ending retained earnings is our beginning retained earnings plus net income minus dividends. Our ending retained earnings will be $5,050. Let's go ahead now and prepare our balance sheet. We will begin with assets. We have $25,400 in cash. From our adjusted trial balance, we have $6,000 in accounts receivable, $250 in prepaid rent, which gives us total current assets of $31,650. We had $48,000 in equipment, less $11,000 in accumulated depreciation, which gave us net equipment of $37,000 and total assets of $68,650. Our accounts payable, we can see from our trial balance, is $2,500. We have $1,600 in salaries payable, $1,600 in unearned liabilities, unearned revenue, for total liabilities of $5,700. We have $68,000 in common stock, and in terms of retained earnings, we know from above we have $5,050 up top, but we can see from our adjusted trial balance it doesn't even include the retained earnings account. So for now, let's go ahead and put zero in for retained earnings. This gives us stockholders' equity of $68,000 and total liabilities of equity of $73,700. And of course, our balance sheet does not balance, which is odd since all of our journal entries require us to keep our accounting equation in balance. Recall, however, let's consider one of our journal entries. We performed services for a customer on account for $38,500. We said this was an increase in accounts receivable and an increase in revenues. And certainly we had debits equaling credits. But in making this journal entry, suddenly we find our balance sheet is not in balance because we've increased an asset, but we haven't changed a liability or equity account. However, recall, revenues will do what? Revenues will cause net income to increase by $38,500, which will in turn cause an increase in retained earnings for $38,500. And so in recording revenues and expenses, there's an implicit or indirect impact on retained earnings that we have not yet recorded. Brings us to our closing entries. Our closing entries try to accomplish two things. One, we've seen we need to update retained earnings for the impact of revenue and expense transactions. And then the second reason for closing entries is to zero out our income statement accounts, our revenue expense accounts, which are also called nominal or temporary accounts. Let's go ahead and go back and take a look at our general ledger accounts. Now our balance sheet accounts are referred to as permanent accounts, and our permanent accounts, cash, accounts receivable. Think about it. When we go to bed at December 31st at midnight, we have $25,400. And ideally, we wake up on New Year's morning, we still have $25,400. If our customers owe us $6,000 at midnight on December 31st, they will also owe $6,000 on January 1st. If we have $48,000 in equipment at midnight, we will have $48,000 in equipment on January 1st. However, from an income and expense perspective, we go to bed on December 31st with $39,300 in revenues for the year. But when we wake up on January 1st, we should have zero for our revenue balance. The same is true with our operating expenses. We should have zero for operating expense, zero for depreciation expense, zero for salaries expense, and zero for rent expense. So we're going to find our closing entries accomplish the two goals that we need to do. They are going to update our retained earnings and then zero out our income statement accounts to set the stage for the coming accounting period. Let's go ahead and take a look at our closing entries. Currently, service revenue has a credit balance of $39,300. To zero that out, we need a $39,300 debit to service revenue. Well, if we debit service revenue, we need to credit something else. And that something else is going to be retained earnings in the amount of $39,300. Because recall, we said that revenues increase net income, which will ultimately increase retained earnings. Our expense accounts have debit balances. To close them out or to zero out those balances, we need $17,000 credits. So we'll credit operating expense for $17,000, which makes the balance go to zero. We will credit depreciation expense for $11,000, which will again make that balance go to zero. Salaries expense will be credited for $13,600, which will make salaries expense go to zero. Rent expense will be credited as well for $2,750, which will make rent expense go to zero. The offsetting debit to all these entries, of course, will be an increase to retained earnings in the amount of 17 plus 11 plus 13,600 plus 2,750, a debit to retained earnings of 44,350. This gives us an ending retained earnings balance of 44 minus the 39, 5,050. And that's the debit balance that we needed for retained earnings to make our balance sheet balance. Let's go back over to our balance sheet. The negative balance for statement of retained earnings indicates that we've had a cumulative loss. And we can put in minus $5,050. That brings down our total stockholders' equity, and our balance sheet now balances. So let's go ahead and formally record those closing entries. So we had a $39,300 debit to service revenue and a credit to retained earnings. And of course, this has no impact on our net income. And for our expenses, we will debit retained earnings and credit depreciation expense for $11,000, credit operating expenses for $17,000, rent expense for $27,000 or $2,750, and salaries expense for $13,600. And the sum of all those will be our debit, in this case, to retained earnings in the amount of $44,350. And of course, there's no impact on our profit margin from recording our closing entries. Once we prepare our closing entries, we will post them to the general ledger and prepare our post-closing trial balance. And notice on our post-closing trial balance, since we had a deficit in retained earnings, the debit balance is our current balance for retained earnings, and we have zero balance in our revenues and our expense accounts. Let's go ahead and still the last thing we had to do was to prepare our cash flow statements, and we're going to prepare our cash flow statements using the direct method where we look at actual changes or cash transaction accounts. In our direct method, we simply look at cash inflows and cash outflows. Let's begin with our investing and financing cash flows because we can easily identify those. Recall the $48,000, that was the purchase of equipment. So we had a $48,000 outflow related to the purchase of equipment. And in terms of financing activities, our only inflow was the issuing of common stock for $68,000. Anything then remaining in terms of the debit side of our cash general ledger account would be a cash inflow related to our operating activities or from our customers. So we would have had the 2,400 plus the 32,500. Those would be our cash inflows from operations. And the remaining outflows would have been our cash operating outflows. So minus 3,000, minus 12,000, minus 14,500. So our total operating cash outflows, 29,500. The net cash flows from operating activities, 39 or 34 less the 29, 5,400 from operating cash flows. Our investing cash flows were negative 48,000 or 48,000 outflow. We had 68,000 coming in from operating activities, and our net change in cash then would have been 54 minus the 48 plus the 68, or 25,400. Again, this was our first year in business, so our beginning cash balance was 0, which means our ending cash balance should be the change in cash plus our beginning balance. And sure enough, it ties in with our general ledger account and our adjusted trial balance. Finally, recall, in setting up your T accounts for 2005, you'll want to make sure your opening balances are your balances from your 2004 post-closing trial balance. 25,400 for cash, 6,000 for receivables, 250 for prepaid rent, $48,000 for equipment, $11,000 credit for accumulated depreciation, and so on, making sure that you have 0 balances for your revenues and expenses, and that you pick up all of your liability and equity accounts, including your ending retained earnings that has a debit balance of $5,050.